Palantir just posted the most profitable quarter in company history. Margins up, revenues up, commercial customers up nearly 50%, and the stock down almost 8%. Why? Simple. This isn't about earnings. This is about emotion. The Nasdaq dropped over 2% yesterday. The VIX spiked more than 10%. The Fear and Greed Index sitting at 23. Extreme fear. That's the mood we're in. When fear hits, facts get ignored, valuations get punished, and even great companies bleed. So yes, part of this is the market, but let's be real. Palantir was already soft in after-hours trading on Monday before the Tuesday sell-off kicked in. That means this wasn't just a sympathy dip. Wall Street wanted more from Palantir. More growth, more clarity, less story, more scale. And now every retail investor is pointing fingers at the market, at Michael Burry, at the bubble. But here's the truth. Palantir didn't fall because it failed. It fell because it's misunderstood. The stock got ahead of the story. And when you price perfection, even a great quarter isn't good enough. So the question isn't, why did it drop? It's, did anything actually break? Because what I see is a business scaling up, not falling apart. And that's what this episode is about. So let's go deeper. Please stop asking if Palantir beat earnings. Ask what it built. Most people treat earnings season like a scoreboard. Did it beat? Did it miss? Did the stock go up? None of that matters if you don't know what the business actually did, because a stock can pop on junk data and collapse on strength. The market isn't rational in the short term, but execution is. So here's what Palantir actually did. It pulled in $1.18 billion in revenue. That's up 63% year over year. Net income came in at $476 million, more than 3 times what it did last year. Free cash flow, $540 million, up from $120 million just 2 quarters ago. Let's talk margins. Adjusted operating margin hit 51%, which means for every dollar they brought in, they kept more than half. And yet, here's the part everyone misses. Those are not just numbers, they're signals. They tell you the business is scaling. They tell you Palantir is no longer surviving on government contracts. It's growing in the private sector, and it's doing it with margin discipline. This is no longer a bet on potential. It's a bet on whether the engine can run at scale without breaking. The takeaway is simple. Palantir didn't just beat earnings. It delivered the most profitable and operationally efficient quarter in company history, and the stock tanked yesterday. If that doesn't tell you how misunderstood this business is, nothing will. Palantir's commercial engine just took a major leap forward. The biggest mistake investors make with Palantir is thinking it's still a defense contractor in disguise. That version of the company is gone. In quarter 3, U.S. commercial revenue grew 33% quarter over quarter. Year over year, plus 103%. That's not a rounding error, that's a rocket. And here's where it gets even harder to ignore. Total U.S. commercial customers are up 260% year over year. This isn't a slow organic adoption. This is a flood of demand. That growth is being driven by AIP, the artificial intelligence platform. It's not just a product, it's a wedge. It gets Palantir inside the organization fast. It gets Palantir inside the organization fast, where it spreads. This is classic Trojan horse strategy. Get in with AI, expand into operations. And the proof is already here. Tampa General Hospital used Palantir's platform to reduce patient stay times by 30%. That's not a dashboard, that's a critical system. Every extra hour a patient stays is money lost, outcomes worsened, and resources tied up. Once a system delivers that kind of leverage and becomes embedded in daily operations, it's not software anymore, it's a dependency. Removing it is like cutting into the nervous system. You don't just lose functionality, you degrade performance across the board. This is what makes AIP dangerous, in a good way. It starts as a tool, then it becomes the operating logic. It spreads from workflow to workflow until the organization can't function without it. At that point, the cost of removing Palantir becomes higher than the cost of keeping it, which means every contract isn't just revenue, it's a foothold that compounds into strategic control. Meanwhile, commercial contract value exploded to $1.3 billion this quarter. That's a 342% increase from the same time last year. Let that sink in. 4 times bigger. And for the first time, the growth rate in commercial is outpacing the government growth. That flips the entire Palantir narrative on its head. This isn't a defense software company anymore. It's becoming the operating system for industrial AI in regulated sectors. So if you're still thinking about Palantir as a government-heavy play, then you're already behind. The shift is real, the numbers prove it, and if this trend holds, Wall Street will have to reprice the entire business model. Most people still look at Palantir like it's an expensive science project with a few big contracts holding it together. The numbers say otherwise. This quarter, Palantir posted $476 million in GAAP net income with a 40% net margin. Adjusted operating margin, 51%. For every $1 they brought in, they kept more than half. That's not a startup trying to find product market fit. That's a company with operational force and discipline. And it's accelerating. Profit has scaled from $187 million in quarter one to $297 million in quarter two to $476 million in quarter three. That's not a spike, that's progression. They didn't tighten spending to protect margins. They grew into them. Free cash flow also surged to $540 million, a 4.5 times jump from just 2 quarters ago. And it's not coming from gimmicks. It's coming from software margins, AI deployments, and commercial contracts that expand naturally. This is what mature profitability looks like when margin control becomes structural. The cost to grow is shrinking, the margin on every new dollar is rising, and for a company trading at 85 times earnings, that matters because valuation premiums only survive when they're backed by compounding leverage. Palantir doesn't need to prove profitability anymore. It's now proving how much operational leverage is built into the machine and how far it can scale before it breaks. Most investors misunderstand what makes a software company defensible. They look at code, features, patents, but in enterprise AI, that's not the moat. The real moat is how deeply you get into the bloodstream of the business and how painful it becomes to remove you. Palantir software doesn't just run on top of operations, it rewires them. It becomes part of how decisions are made. Once that happens, you don't get fired for signing the deal, you get fired for ripping it out. You can see that clearly in the public sector. Palantir is running critical systems across defense, intelligence, and health. But now the same thing is happening in commercial. Companies aren't buying software, they're offloading complexity. Take Tampa General Hospital. With Palantir, they reduced patient stay times by 30%. That's not a nice to have. That's a revenue driver, a staffing unlock, and a performance boost. If you pull that system out, you don't just lose data, you lose results. Once AIP is embedded, removing it is like amputating an organ. The cost of extraction is higher than the cost of continuation. That's when software turns into infrastructure, and the customer becomes locked in by necessity, not contract terms. And that's what investors keep missing. This isn't a product, it's a logic layer that governs entire systems. It dictates workflows, automates responses, and increasingly thinks for the organization. There's a reason Amazon and Microsoft are integrating with AIP. It's not competition, it's alignment. They're plugging into a standard, and that standard is Palantir, and it's getting harder to compete with every single quarter. Let's talk about the elephant in the room. Palantir trades at over 85 times earnings. That's not just expensive, that's the highest valuation multiple in the entire S&P 500. And if you don't understand why, you probably shouldn't be in the stock. Because at this level, you're not buying what the business is, you're buying what it's becoming. And make no mistake, this is high risk. So here's what that transformation actually looks like. Palantir now serves 911 total customers, up 45% year over year. And on the commercial side, 742 customers, up 49% year over year, with consistent growth every single quarter. This is not a company dependent on a few whales. This is infrastructure spreading through the economy like a slow-moving virus, one that companies invite in and can't remove once it takes root. The old bear case about customer concentration is dead. This isn't a government contractor with a few lucky bids. This is an operational intelligence system being embedded across hospitals, manufacturers, logistic firms, airlines, and banks. But the risk is still real, and here's where it sits. Palantir is priced for execution without error. At this multiple, even a good quarter can trigger a sell-off if expectations outpace delivery. And if micro slows or AI budgets pull back, the growth story compresses fast. But here's what balances the equation. This is a company that just posted $476 million in GAAP net income, $540 million in free cash flow, and it did it with zero debt and $3.5 billion sitting in cash. Its Sharpe ratio is around 3, meaning the reward has outweighed the volatility by a lot. And the further AIP embeds itself into mission-critical systems, the harder it becomes to replace. This isn't a product anymore. It's a decision layer, a logic engine, an invisible operating partner. So yes, it's expensive, but premium valuations are not the enemy. Failure to scale into them is. Palantir is doing both. growing and proving it can run with margin strength. That's not hype, that's real horsepower. Let's put the scoreboard away. Forget the stock price, forget the headlines, forget all the hype around AI. The only question that matters is this: is Palantir becoming more dominant over time or less? Here's the bull case. Palantir just delivered its most profitable quarter in company history. It's generating over $500 million in free cash flow per quarter. It has 911 total customers and 742 commercial, growing 45% and 49% year over year. And it's now embedding AIP into operations where the software becomes part of the nervous system, not a tool, but a requirement. Once a hospital cuts patient stay times by 30%, you can't rip the system out. Once a manufacturer is using Palantir to allocate resources in real time, you don't go back to Microsoft Excel. This is software that hardwires itself into the operating model, and the deeper it gets, the harder it is to replace. That's not just stickiness, that's control. Now the bear case. The stock is priced for perfection at 85 times earnings. Any mistake will hurt. Government contracts still make up a big chunk of revenue, and political risk exists. Commercial AI budgets may tighten if macro conditions worsen, and high expectations plus high visibility equals no margin for error. Execution is not optional at this price, it's the entire game. The bottom line is Palantir is scaling revenue, customers, cash, and margins all at once. It's being integrated into the operations of sensitive, regulated, and critical sectors. And it's building a strong moat, not from code, but from dependence. When the cost of removing your product is higher than the cost of keeping it, you've stopped selling software and you've started selling infrastructure. That's what I believe Palantir is doing. That's why Palantir is my largest position. That's why I've literally made millions from Palantir. And if you believe the future of AI is in deployment, not just development, then this stock isn't a hype trade, it's a backbone play. Palantir is becoming the picks and shovels supplier for AI deployment, not in theory, but inside the most regulated and mission-critical sectors on the planet. Defense, health, energy, industrial operations, not dashboards, not demo day fluff. Real systems, real outcomes, real dependence. Once it's in, it doesn't leave, because you're not just adopting software, you're literally building around it. So here's the real question. Is the business getting stronger every quarter? Are the numbers trending up across customers, contracts, and cash? Is the product becoming harder to compete with? If the answer is yes, and I believe it is, then what more do you want? You're positioning yourself in front of an operational platform that's scaling into everything. Sure, this is still high risk, high reward. Execution matters, competition is always coming. The valuation is stretched and the pressure to perform is real. That's why I never go all in on any one position. But when the thesis keeps playing out and the business keeps getting stronger, I pay attention. My thesis on Palantir is bullish. I'm overweight on Palantir and not trimming yet because I want to let my winners run. My goal is that you understand both the bull and the bear case. Which one you believe? Well, that's up to you. I'm bullish, but you do you, boo. Now let me ask you something. Who else is breaking down Palantir's commercial momentum, hospital case studies, and scaling margins while actually showing you how to build a position with discipline? Who else gives you the bull and the bear case, ties it to real execution, and helps you decide what to do without the usual hype? Nobody. That's why Palantir is my largest and most profitable position. And it's not just me. Rosalinda's account is up 53.35% over the last year, and she pulled in $12,315.92 in one day. Akira's first month trading options up 7.47%, and more importantly, learned real risk management for the first time. And Steven just locked in $11,819 in net gains in October alone, his first five-figure month. My accounts are now up $2.6 million in 2025 with a 74% year-to-date return. This isn't theory, it's execution. Inside my Patreon, you get real-time trade alerts, every entry, every exit, every reason. Daily market breakdowns, only what matters, no filler. My momentum system, the same one I use to scale seven-figure positions. And access to the most committed, data-first community of investors I've ever seen. It's $30 a month. Instead of blowing that on bullshit, put $30 into something that actually makes you better. If it doesn't 3x your investment in yourself, cancel anytime, no questions, no pressure. Many of my members have been with me for 6 years. Why? Because this community helps them grow and it keeps making them money. The real question is, are you ready to stop watching other people win and finally become one of the success stories I feature? I'd love for that to be you. Because the truth is simple. You can scroll or you can scale, but either way, you won't say you didn't have the chance.